Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Wendy Schiller, she's a professor at Brown University, joining us this morning. Wendy, thanks so much for joining us here. I'd love to get your thoughts here on the selection of JD as vice president candidate there. What did you make of it?
Well, I mean, I think it's the smart but safe choice. I think, Ohio leans red in recent elections. So it solidifies Ohio and it represents, coherence to the Republican platform. It's a missed opportunity as far as I'm concerned. I think that Donald Trump had momentum, and then, of course, the tragic attempt on his life and the loss of life at that rally gives him a platform to extend the tent for the Republican Party. So someone like Tim Scott, I think, would have appealed not only to Black voters for identity politics or descriptive representation reasons, but also to independent voters who are looking for signs that the Republican Party might be moderating somewhat because they've rejected the most extreme candidates in recent elections.
Wendy,
so I think it's a missed opportunity.
To me, Wendy, I totally see what you're saying. To me, there's a new acuity this morning. If Trump-Vance is going to go against Biden-Harris or something else, did that polarity in the Democratic Party change with this announcement of JD Vance?
Well, if anything, I think it doubles down on Kamala Harris to continue to be the VP candidate. And possibly, if Biden steps aside, there's still a little bit of time left for that, for her to be the top of the ticket. It becomes a very stark contrast between a ticket that looks a little bit like the past on the Republican side and a ticket that looks much more like America looks and the future. So I think, again, I'm not sure this does anything to woo back independent voters, which is exactly what the Trump campaign needs to solidify their lead and win the election. I mean, they're going to get every Republican. They've solidified that. The Republicans are going to be, and they're now counting on unenthusiastic Democratic Party and low turnout on that side and just core Republican turnout on their side.
So, Wendy, we saw former President Trump make his entrance into the RNC convention yesterday with the patch on his ear. What do you expect him to say in his speech here? Do you expect a different tone from this president? The suggestion seems to be that may be where he's leaning.
Well, I mean, he's certainly done a very good job before this incident of staying disciplined, particularly on reproductive rights and abortion, promising no national ban. I mean, that's where JD Vance's selection kind of contradicts some of his attempts to moderate on abortion, which has been a real problem for the GOP electorally. So that's the confusing part. JD Vance doubles down and is very conservative on that issue. So how do you explain that away? But, will he say, I've learned a lot about life? Will he get personal, emotional? We'll have to wait and see.
I'm fascinated, Professor Schiller, how the former governor of South Carolina adapts to this announcement tonight. I was joking with Laura Davison. What percentage of the Republican floor is traditional Republican versus MAGA? What would you suggest it is? I mean, is 80% of the floor of the Fiserv Center in Milwaukee MAGA? Is it a bigger number than that?
I think that number is probably right. There are always establishment Republicans that go to the convention. So they're elected officials from all the 50 states in the Republican Party, and not all of them are as MAGA as Trump. So, that percentage of the delegates won't necessarily be MAGA dominated. But the House right now, the Republican Party in the House, you'd have to say 150 of them are MAGA. And that's going to change in the MAGA direction when we go into 24, because some of the retirements on the Republican side in the House are more moderate. So I do think it's a wholly owned MAGA Trump party. And now with JD Vance on the ticket, that's what they're doubling down on.
So who's Nikki Haley talking to tonight? besides, what's to come in 2028? I mean, is she speaking for a cabinet position?
I just don't know. The fate of people who align themselves with Trump is not usually good. They either, get indicted and go to jail or get indicted and don't go to jail, but they fade away. I mean, it's anybody outside himself doesn't always do well by being associated with him. So it's a bit of a political gamble. She's, what is she doing? Trying to, keep her ties open, keep it open. But now with a young JD Vance as the VP, that if Trump wins, that pretty much crowds out almost everybody else.
Where do they go? I mean, Paul, that's the arch question, right?
Yeah. So, Wendy, again, what do you expect? Is there anything new to come out of this convention here, this RNC, or is it just Trump moving this party forward?
No, Paul, I think what could be new is if tonight's conversation or rhetoric about immigration is not dehumanizing the way that it's been about the southern border. In other words, Biden failed, it's not secure, that's the rhetoric of the GOP. But if you really start to say everybody's a criminal, et cetera, I think that turns off independence. So what could be new here is if Trump can actually moderate the rhetoric and language on immigration, which he's never done. But if he can, that helps them a little bit with independent voters. So what I'm looking for, which is new, is a softening a little bit about the way that they talk about these issues. I don't know if that will happen, but I think it's a risk for the Republican Party not to do that.
What to listen for tonight. Wendy Schiller, thank you so much. Amy Wu Silverman with RBC Capital Markets. Amy, there's a right tail in the distribution, the risk that we measure, which is the goodness of a story. There's a left tail, which is the angst. What does the left tail of NVIDIA look like?
The answer is the left tail isn't really up all that much. You're not having that much worry, but importantly, the right tail has come in a lot. So I think that's a big deal in a name where the right tail has actually been outweighing the left tail. That's very unusual, except for a name like NVIDIA. So for that right tail, that exuberance to have come in so much, I think that's important, and we'll see how that moves as we head into earnings.
As we head into earnings, for you as a legit quant, what part of fundamental earnings matters to a quant?
I always go back, Tom, to the variance of a portfolio. It's like my favorite pet formula right now because it always goes back to the breadth, the weight of the market. And we kind of know that when you look at the math, the weight of tech matters so much, right? We can talk about broadening, we can talk about all these things, but it's still those 7 names that make the majority of the contribution of returns. So again, I'm watching earnings of the Mag 7, I'm watching earnings of NVIDIA. And when you start to see that right tail get sucked in as we head into earnings, I don't know how great a sign that is.
And Paul, that's where mere mortals like us talk about absolute and relative. And the media loves to talk about relative analysis. And what Amy Wu Silverman's saying brilliantly is the absolute mass and weight of tech is just ginormous. That she learned that at Princeton. Ginormous.
Exactly right. Exactly. And so, Amy, as Tom was just saying here, it seems like this whole earnings season really hangs on a handful of stocks and really their forecasts. Because when and if this AI momentum breaks, that could be a problem not just for the individual stocks, but for the market overall. How are you thinking about that?
Yeah, look, I've kept saying to our clients, if tech goes, the market goes. And we've actually seen that a few days. So when we talk to investors, they say, look, we can't wait for the market to broaden. We can't wait for maybe IWM to outperform S&P. The thing is, when you see that happen in the past on certain days, you actually are getting a down days in the S&P or the Dow, because again, it comes down to that weight. You could have a healthy broadening of the market, but if tech isn't playing nicely, the overall market is still not going to be doing well. And so, we're looking at hedges there. We're looking at something like collars where you sell a little bit of upside, own a little bit of downside. I think that's relatively inexpensive right now because all options are really inexpensive, and you continue to have your headline VIX sub 13, even with everything going on.
Why are options inexpensive? Explain how that market works to us.
Yeah, I've been calling this market the paddling duck market. I haven't been able to find a better analogy, so let me know. But look, it's calm on the surface, right? But those feet are paddling really, really violently underneath. You get these rotation days. I think last Thursday was a good example. You had one of the most historic IWM to S&P rotations on record, flips the next day, and you keep seeing that, but when they cancel each other out, you don't see it on that index volatility level. So right now, average single stock volatility compared to index volatility is at its highest spread ever. It's a really big deal, but you just cannot see it when you just look at the VIX alone.
We're coming in, when you think about, at least from my perspective, my experience, September and October, rough times for the equity markets. What's the risk for this market heading into the fall, heading into, again, this concentration risk in these tech names?
I've been thinking about that a lot, and it's interesting because we are heading into U.S. elections. And when you look historically, the market does tend to rally into U.S. elections. And, one stat that I just think is super interesting, after the first presidential debate, the implied volatility on actual election day actually went down. It compressed, essentially the market saying that there's a more definitive likely winner to the presidential election. The thing is, when you also look to history, there's a lot of surprises and a lot of runway between now and U.S. elections, especially when you look seasonally at VIX. VIX tends to spike. So I think, again, things are inexpensive. You can be the boy who cried wolf, but you do need that exogenous shock to the market to change things.
Amy, one final question. I look at the option space and the derivatives analysis, and the heart of the matter is we've got this polarity between capital-heavy industrial America and technology capital-light America. What does derivative space say about the potential long winning of capital-light technology? What does it say about we just don't need that much money, we've got innovation, we've got people?
Yeah, it's interesting because we track this in two different ways, Tom. We kind of track this through two different kinds of baskets, high quality basket versus low quality basket, which tends to be tech against everything else. Mm-hmm. But we actually track it against Trump basket versus Biden basket, which also tends to be one heavy industrials, one not. And when you look at the pricing overall, there's just not that much differentiation right now. And one of the reasons, Tom, is just everything's really low. And again, I think that differentiation probably needs to happen as we head towards elections and different political themes.
Amy with Silverman, thank you so much, RBC Capital Markets. Joining us now, and 8 ways to go in a 3-hour conversation, Dana Telsey, Chief Executive Officer, Telsey Advisory Group, definitive on retail, and really to the heart and soul of her childhood as well. Dana, Paul's got a bunch of questions on retail, but I got to talk to you now about the character of luxury turned upside down. And it can be anything besides famous brands buying huge amounts of real estate on Fifth Avenue, and on the other side, detailed articles of heavy discounting in China. I mean, just as an example, the people from Venice, Bottega Veneta, that's the basket weave leather things every woman needs. I mean, Dana, what in God's name is going on in retail? Is it, and I guess the summary is it going to be an Arno roll-up?
In luxury retail, and Tom, thank you, and Paul for having me today. I think overall you are seeing the big getting bigger. You look at Fifth Avenue, like you mentioned, and could it be one day that the four corners of 57th Street are all occupied by LVMH? Right now they occupy 3 of the corners, and Goodman is going to be owned by Saks if the transaction goes through with Neiman Marcus. But luxury goods, and I had just gotten off the phone with Rishman, it's interesting some of the resiliency that's out there, given the fact that we have seen moderation. The Americas is holding up, even with sales having moderated. And I think as we go through this earnings season cycle, we are going to see everyone's become a little bit more discerning. And we haven't seen the return of tourist travel from the Chinese. And that's the arbiter to come.
I mean, and this is brilliant. I mean, Richemont, I believe, is Cartier. I get that these iconic names that will always be there. But in the reporting I saw on China, Montclair is the fancy ski jackets that your kids need, Paul.
Oh, okay.
If I don't have a Montclair jacket, I'm not going to be able to survive. Dana Telsey, Montclair's discounting 50%. In 2 years or 4 years, where is that partition of luxury between the successful fancy people and the others discounting? I just don't get how they survive.
I don't think discounting is really a part of the luxury ethos. And one of the things we've seen happen, and we see basically less discounting in leather goods than in other categories. Certainly some of the major European houses don't even discount at all. I think what you see with some of the fashion pieces out there, and certainly those where you have weather trends that dictate things, you do have to move inventory. It's going to be very interesting to see now, you mentioned it earlier, what happened with Burbridge with the changing of the guard that's going on there at the C-level position.
Hey, Dana, we got some retail sales data that came out this morning, and just looking at the controlled group, positive 0.9% above the consensus for 0.2%. So it looks like from that data point, the consumer's doing pretty well. Does that tie in with what you're hearing from your retail companies that you follow?
I think it's very mixed. I think overall back to school is going to be very measured. From the retailers I'm looking at, look at the data points that we got last week. You saw strength at Aritzia, a very big apparel retailer, with frankly only 52 stores in the U.S., an opportunity to grow. You saw, talk about luxury, Brunello Cucinelli, saw strength in the U.S., up high teens. But then you saw companies like Pepsi say that they're seeing the customer be very more value-minded and discerning in what they're spending after 3 to 4 years of elevated pricing and inflation. That even the higher income consumer is measuring the restaurants they go to and the frequency. So I'm thinking it's very measured, and we've seen a moderation in the spend.
Dana Telsey, how do you and Joe Feldman study charge card data? Michelle Meyer joined us here 10 days ago from MasterCard, and she says, look, this is what people are doing, they're spending, and we just saw it with a good retail sales report and good revisions. How do you at Telsey Advisory Group study what Paul Sweeney does over the weekend with his charge card?
A couple different things. So number one, we're going to the stores ourselves and talking and seeing what the promotions are. Number two, we're doing weekly web scraping data of what the promotions look like week over week, but also we have this data going back years. So we look at it year over year too, in order to assess the changes in pricing, but also the changes in product trends. And then we're looking at the quantitative data of different snippets that we can glean, whether it's of credit cards or whether it's of company commentary, like what you had last week, outside of the purview of just retail, as long as it relates to the consumer.
Dana, thank you so much. Dana Telsey there on luxury, the struggles in China as well, with the Telsey Advisory Group. This is a really important conversation because he has the one volume book where you go, how did we get here? And the answer is nobody got us here with one volume like Chris Whalen. And he joins us right now in a massive rewrite of his classic Inflated. And I've been livid about the lack of historical analysis of this grim assassination attempt. And nobody's done the one volume history of our finance like Chris Whalen. He joins us in our studio today. Page 146 of your book is the analog of the pandemic of 1919 and what all of our grandparents said was the Roaring 20s.
That's right.
Are these the Roaring 20s right now?
I think in many ways it is a repeat of the 20s. We have deflation in commercial real estate instead of the farm sector. But we have a boom on Wall Street because there's not much else going on. And Americans always manage to, find their way to the securities markets when everything else.
But that analog ended.
Yes, it did.
Where is our 1929 out there somewhere?
No, I think, as my friend Stan Middleman says in the biography I'm coming out with in September, 2028 will be the maxi reset in housing after 12, 13 years of going up. You know, we run out of buyers at a certain point. It won't be a supply side function this time that just brings more homes in, as we saw before. That won't be the issue. It'll just be people unable to buy them because they're so expensive.
Well, affordability today is an issue. I hear that from real estate folks across the board here, and there's not a lot of supply. And
this is the cost of quantitative easing. It solved a lot of problems at the time. We were allowed to fund forbearance for borrowers and renters in this country for 2 years by stealing from Peter to pay Paul. But now we pay for it.
All right. I've been around the block once or twice here. I've been hearing about, reading about deficits, our national debt forever. I'm starting to hear about it a little bit more from economists, from politicians. Where is that on your radar screen of we got to deal with these things at some point?
Well, a lot of people ask me that question, and what I tell people is that the United States has a lot of collateral. So when you throw $35 trillion at me, on the one hand, I worry because it shows a lack of discipline on the part of our society. We can't borrow from our children forever. We have to stop. Thomas Jefferson addressed that very specifically. But on the other hand, Jim Pinkerton said to me the other day that energy in this country is worth $175 trillion. So should we worry? No. But this country has the income and the assets and, most importantly, the people to fix it. So we can fix it.
If we get a Trump-Vance presidency, and without question there, the legislative branch could block, but we get a reaffirmation or an enhancement even of what I'm going to call the Trump tax cuts of a number of years ago. Do we have an analog of that in your book, Inflated? Is there a point where we legislated a good outcome for the elites versus the rest of America, like we seem to be in process of doing?
Really, from Nixon on. You know, Nixon didn't take us off gold. He just closed the window. FDR took us off gold. But what he did was he enshrined deficit spending. And from that point on, we didn't look back.
So your Gilded Age is a lot wider than the modern perception of it.
Yes, because it's a function of war. It's a function of the hubris of a society that triumphed over fascism, used production to do it, by the way. We outproduced them. We didn't outbuild them and fight them. We outproduced them. And so today, here we are, the most prosperous nation in the world. Remember Humphrey Hawkins? We thought we could legislate economic outcomes. It reminds me of Tolkien and the earlier parts of The Lord of the Rings, when the men thought that they could become immortal and got into big trouble. So, you know, this is a maturation process. Because remember, 100 years ago, most people in this country had never been 10 miles from their birthplace. This country didn't know about things like debt and foreign wars. Today, we are the Roman Empire redux.
So, I mean, there's a million ways to go from that, but the one near-term issue that I think people are concerned about, at least I'm just thinking about the banks reporting over the last several days, is when and if is commercial real estate going to become an issue for the banks and for this economy? Because it seems like it's been several years now, and I didn't hear JP Morgan talk about it too much. I didn't hear Bank of America talk about it too much.
And to layer onto that, Chris, every conversation we have with CRE pros is a rationalization of, everything else is doing fine except what Paul's talking about.
No, it's chop salad. Every asset is different. That's why you don't see it hitting the media narrative, because it involves institutional investors, pension funds, everybody else who don't have a lot of political sympathy, let's be fair. We worry about consumers. We don't worry about landlords. So the landlords took a kicking during COVID, and here they are, and they don't have the cash to hang on to these buildings now that all of a sudden financing rates are back 7, 8, 9% for 7-year money, okay? We were financing these things at 2%, Tom, at cap rates of 1. Obviously, that was not going to be sustainable.
So is this something that there is a shoe to drop?
Yes,
is it? And
but
is
it's quietly dropping.
Okay.
Shoes dropping. Think of little shoes, REITs, private developers, people you don't normally read about. If you want to hear about this, read The Real Deal. In fact, I'm surprised Bloomberg hasn't made them an offer. They're having such fun at The Real Deal, covering this value destruction. Because remember,
it's amazing. Every day there's a story.
They can't cover 10% of them. And remember, these assets went up for a century. When I rated the small banks here
some
in
of
New York, they'd never seen a default.
A very famous real estate guy, folks, in New York said to me, "You don't understand, Tom, these are family stories."
Totally.
And there's families that are 3-4 generations,
Yeah.
and they want a cash call, and they're like, "We can't make it," or "We don't want to make it," whatever.
Well, you know what's the most chilling thing I read the last week or so? When the head of Related decided to carve out his Florida business, which he will run, and he's stepping away from the big company.
Look what he did with the Dolphins, Steve Ross.
No, he's one of the smartest guys in the business, but he has some assets that are great.
Right.
And so the west side, Camden, the rail yards on the west side now.
I got to get this in. Michael Barr's in here, so we got to cut it short. But Chris Whalen, this is too important. I have a chart which is normalized back to August of 2007 of 6 big banks, Goldman Sachs, Morgan Stanley, and 4 others. Though Citigroup is not a big bank anymore. It just hasn't recovered. How do you perceive Citigroup versus JP Morgan and Bank of America?
Well, they're a top 5 money center bank because of the payments platform. But you're right, they have pulled back. There was a time when Citi was the biggest derivative shop in the industry. You know who it is now? Morgan Stanley. Morgan Stanley and Goldman now
Where
lead
do you
that parade.
perceive Citigroup in 5 years?
Merged with somebody else, maybe with a big asset management business, maybe Schwab. But that's what they're missing right now. They sold that to Morgan Stanley with the Smith-Barney transaction. They don't have the asset manager to make them look like everybody else. And they're still, Fraser has done enormous work there in terms of getting their expenses in line, but she still has to cut 5 points out of their efficiency ratio before she can even talk about Jamie Dimon. That's the high bar he has set.
10 seconds. Who would buy them? Who's lined up to be the one to fold in Citigroup and their international
I keep
excellence?
saying they should merge with Goldman. Let Citibank run credit.
Okay.
Let the Goldman boys run deals. Because Goldman cannot run credit to save their lives. They're getting a kicking every quarter in credit.
Now, this is the Chris Whalen we know. After a beverage of his choice, he's like this. Chris Whalen, thank you so much. We
That'd
wait
be
for
great
the
day.
second edition of Inflated. The movie rights have been sold. It's going to be interesting to see, to say the least. This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.